Okay, welcome everyone. We'll start our lesson 2. Today lesson will go through our LO2 learning outcome 2. As you know me, my name is June Sathar. If you have any question, drop me email and you will stay.co.uk and I'll try my best to get back to you as soon as possible. Okay, let's start our lesson. I'll share with you the slide. During last lesson, we discussed about resident, what is meant by, we discussed about VAT scheme. We had a discussion about tax planning and how we can and foreign elements, capital allowance, and we discussed about Finance Act 2024 and Finance Act 2025, and we mentioned, whichever you like to apply depends. Yes, it's good to be use the latest Finance Act. Okay. This week, we're looking LO2. We'll start. Hope so you can hear me. Those are online. Please, if you those are listening, if you have any questions, please drop me email and you at university.co.uk. I'll try my best to get back to you as soon as possible. Hello, good afternoon. Can you hear me, sir? You okay? We'll start. If you have any question, please you can ask. This week we're looking at LO2 learning outcome 2, which is be able to assess the impact of the relevant taxes in a given situation. So we'll discuss about various situation, how we can plan the tax planning is illegal, which we had already had a discussion during our last lesson. Okay, so please we discuss about resident during last lesson, what is meant by, and if you have a domicile, if you're living 180 days, and the connection with and the domicile. So we had a discussion, so we can say it's resident, and if you're paying the foreign elements of the tax, and then of course you can get the rebate and the tax rate. We discuss about 20%, 40% dividend rate. So we discuss about Finance Act 2024 and 25 during last lesson. We discuss about employment, saving income, inherent tax, and we discuss about tax schemes. Yes, whichever finance act you want to use, please you can just make sure just clearly label which finance act the rate you're applying, because sometimes if you're dealing with the old tax returns, your clients that's also absolutely fine to deal with it. Okay, so this lesson is for LO2, and we'll discuss about always good to be scale 1 to 10, reflect current your knowledge about a tax return. Okay, so please in the following lesson, when we do the assignment discussion, we'll embed more examples, and because it's not a exam based course, it's a assignment based course, please we need to be focused about picking example and according to the criteria and just embedding and writing and explaining them. Okay, so that's the key. And today lesson we mentioned the indicative content, which we'll go through this indicative content assessment, how this affect different financial decision, tax planning, and advantages, disadvantages, various course of action. That will be all in our discussion. Okay, so please, we had a discussion, not a big difference this the previously under this Finance Act. So please, always we need to be think about personal allowance. So 12,570 is the exempt limit. If anyone earning more than that, of course they have to pay the taxes, and you have to decide and the plan and give advice to client according to the finance set. So please 20% and then 8.75 dividend. We can think about the higher rate 40%, 33.75, and then please we can look around for their personal allowance and transferable amount, marriage couples, which we can look around the allowance. Income limit, of course, the 100 after 100, if your is 125, 140, personal allowance will be finished, and then of course, you have to pay tax on the all amount. So please, we have to look around these, and you will see the child benefit. If you're anything is more than 50,000 you're earning, you have to pay and declare the taxes. Please, electric cars. So we have to look around the Indian side, CO2 emission level, corporation tax, which we can still is 19%, but that we can explore about. Look at the finance document. So please, these are all the rates which will refer back capital allowance for individuals and companies, because this year unit is individual and businesses, so class one. So please, then again, NI elements which we need to be. And we had a discussion in the previously, which we relate to this RLO as well. So we have to look around non-saving income, saving, and look around the total income, net income, and the taxable income and the tax rate, which we need to be plan and pay accordingly. So let's look at example, please. So this is for it doesn't matter whichever finance sector you apply, but better to be applied the new one. If you're looking the new one, just a matter of applying the rates. So for tax year 2021, or now we can say 2024, if you had the salary, in that case, you had the salary 46,500, the saving income is 2,000, and the dividend income is 6,000. And during the years, the paid, interest 300, which was, for the qualifying purposes. So we can look around the employee deduct, pay as you earn through salaries is 6,800. So we have to think about now. So how we can, okay, so please, we need to be look around. We've been given the rates, so we can say non-saving income. We have please there, and then we have the saving income, which is 2,000. We have the dividend income 6,000. We can say total income is 54,500. So interest paid towards, so that is, this is related to expense allowable. So please, which we can minus. Then we have the personal allowance. The year was 12,500, but now if this current finance act, we have a 12,570. So we have to minus 12,570. Okay, then we, after this, allowance, we have the taxable income 33,700 for non-saving, 2,000 is the saving income, and 6,000 is the dividend income. So scroll down and we calculate the liabilities for this. So 33,700, because up to 37,700 now is the limit for up to 20% tax. So you can calculate 20% tax, in that case. Okay, saving income first 500, because if it's the basic taxpayer, not additional taxpayer, we have to look around the tax bracket, because it's a 54,000 is the income totally. So in that case, only 500 is exempt. So 2,000 was the saving income, 2,000 minus 500, 20% tax on will be 300. Then look the dividend. Dividend is because it's not a basic taxpayer, is the higher taxpayer. So 6,000 minus 2,000, that's the limit you need to, that's free on the dividend. Then of course 32.5% will be the will be the tax rate, not 8.75 in that case, because it's a higher. So that will be the liability. So we can look around pay as you go, which is already pay as you earn, the big, it's been paid, the liabilities through the tax, on the salaries. So we have to minus. So now outstanding tax liability in that case is 1,540 pounds. So we can think about, the remaining, and that's, which we need to be planned. Okay, let's look, anyone, any question, please, if you have, you can ask. Okay, hope you can hear me. Okay, so please next, we're looking now is assessment criteria 2.2. We have to think about, tax advantages and disadvantages and different course of action. So because as we discuss, tax planning is illegal and you can plan the taxes and we can look around all possible options, what the consequences will be each of the options. So please, in this case, we can look around. The salary is 6,000 and husband, wife, and Teresa's salary is 18,000, interest 2,000, dividend. So it is clear from the above information, Donald is the higher tax, the payer with the taxable income is 47,500 in that case. So we have to look around 6,000 minus 12,500, but new rate now for finance act 12,570. So please depend whichever year you applying, go back to the rates and apply the rates. Teresa's basic taxpayer and taxable income is 16,000. And if we minus her, from, so what will be in that case, our total income after that. Okay, so after the allowance, let's, we'll look in that case. So the introduction nil rate band means, about then the tax saving achieve first 500 of the interest income could be for donor because it's a free, because it's a saving income. He's a higher taxpayer. He's only allowed 500, no tax on the saving. The income tax at 20% on Teresa's saving income excess her nil rate band of 1,000. So we can say that Teresa's 2,000 minus 1,000 is 200 pounds she need to pay the tax. If we transfer 500 to her husband because his 500 free limit is waste, so he would his nil rate band and she would save 100 pounds because 500, and she need to pay only 500 pound tax because 1,000 is out of exempt. 1,500 minus 1,000, that will be only 5 on the 500 she need to pay the tax, so she can save 100 pounds because Donald bank have the saving income, and we can, that's which we can look around that perspective at the tax planning purposes. Would be sufficient shares move to the 2,000 dividend income from Teresa to the Donald, or that both use the dividend income up to rate band 2,000, so that can be exact. So we need to be look around the perspective and we need to be follow accordingly. Okay, 2.3 assess the obligation, please, and if you don't follow these obligations, there will be a fine, the penalty. So what sort of penalties can be? Of course, if you're not submitting the tax return on the 31st January of the following year, of the previous years, in the following years up to 31st January, 3 months after the notice to the file return was issued after 31st October, the following end year. So we have to think about the penalties, please. £100 initial penalties, £10 per day, maximum 90 days, 5% tax due, minimum 300, and return more than 12 months is 100% tax due if deliberately concealed, or 300 each case, so we have to be think about in that perspective too. Okay, I included the link for you, please, is to look around the examples of 2023 24 finance act, because the 24 is up to 31st January 2025, and 25 26 is up to 31st January 2026 return. So please, we can follow the rates accordingly, and we can think about, plenty for careless, deliberately errors. So we have to think about careless, deliberately 70%, 100%. So please, these we need to be in line with, and we have to be well aware of, because if these are the penalties, it can, one is called tax planning, the legal, but tax evasion is illegal, and that leads to, okay, so we have to think about, careless 30%, uh, unprompted disclosures. If we do, that can be reduced, because it's a minimum can be. So we have to look around that, accordingly each year these rules, and we have to be follow accordingly, because the compliance purposes is a crucial, so, and we can advise to clients. Okay. Record fees, we keep up to 5 years plus the current year's 6 year record. That is also crucial. Payment of the taxes, yes, payment on account must be made the 31st January in the tax year end, and the following 31st July, and the final payment must be made on the 31st January following year. So we have to 50% of the previous year tax liability less the tax suffered at source, or we have to think about these payment and accounts. So that's, one of the options can be used, and we have to look according to late penalties, not more than 5 months after the penalty date, 5% of the unpaid tax, more than 5 months, not time of 11 months after the penalty date, and the 15% unpaid tax. So we have to be look around these please, and we need to be follow the compliance procedures accordingly. Otherwise, it will be the fine. Okay, non-compliance may be result into the litigation or consequences for the client may have, the material effect on their financial statements. If it is the company, non-compliance, have the wider public interest implication in the term of the potential substantial harm to the investors, creditors. So please, examples include the perpetration, fraud resulting of the significant financial losses. So please, we have to be look around those perspectives. Okay, then please we have to M1 assess the effect of the taxation financial decision made by the individual businesses. So the business may become, affected by the sector tax, which means important to ensure you are complying with any sector tax obligation, different sectors, and reduce your tax cost. And we have to think about it. The taxation can affect your business, and the employees don't often, need to be spent a lot of time on thinking about the taxes and national insurance directly deducted from the gross monthly salary. That can be huge impact, so we can need to be look around. However, the running own business very different. It is important that you take the responsibility paying the correct amount of the tax on your business profit in line with the national contribution. The corporation tax is charged on the profit for the companies. Of course, as a corporation, as a company, when you registered as a public or private limited company, taxation affects the business cost. We have to be, and the capital allowance and other things, in employer allowance, we need to be aligned for all taxes or VAT. These all we need to be well planned. Okay, so please, when we looking our VAT have different schemes, so we can think about the annual accounting schemes. You do one return in a year, please. That's, which we can, and we can advise. Even that was in learning outcome one as well. We had a discussion in the previously. You have to look around the limit to be registered and deregistered, like 85, 87, and 90 going to be. We need to be look the finance act, please, again, for the sake of advice, so annual turnover not exceed 130 5,000. So we have to look around, and must be the scheme if your taxable turnover with 1.6 million. Yes. So if it that, 1.3 and 1.6, so we have to be stay in that scheme. You can adopt. If not, then of course you have to change the scheme. Cash accounting benefit if your bad debts will be automatically adjusted. So only you submit your tax VAT return when you receive and when you paid the tax cash, and otherwise, like the bad debts automatically will be adjusted. And if you are on this scheme, please, you can stay up to 1.6 million if your turnover will be up to that point, including VAT. Okay, the flat rate, please. Again, different sectors can be flat rate scheme, please. Different rates can be discounted given the first year more 1%. You have to look around the flat rate. If your turnover is no more than 150,000 to join, and you can stay in the scheme up to 230,000 if your turnover on the flat rate. It means you have to pay one rate. You don't need to be look around the invoices like the input and output VAT. So that is the useful scheme. Okay, so evaluate the various alternatives. The personal and the business's outcome leads to the different so return. If we don't do the fine late filing as we discussed earlier, inquiries we need to be make sure we carry on contact with the HMRC and explore uh, due dates that we need to be think about. Please annual profit installment are due more than 7 or 10 of the period which we can make arrangement the payments, and that's dividend declaration that we need to be the proportion of the asset and the upper and lower limit and marginal relief that we need to be make sure so well aware of prepare when the company's account and upper limit of the period, and no, so we need to make adjustment in the period and the proportion we need to be research and development expenses. If we need to be, can we capitalize it or we can claim the capital allowance if it, because the definition of the asset which we need to be in the perspective of, so we need to be look around those okay, the return and inquiries need to be I guess basic period rule commencement of the trade, excess, using opening year rule, ongoing of 12 months, and seize the business, please, we need to be look around the years, 12 months, if less in proportion, that we need to be follow the rules, the closing years when you're closing the trade. Total trading profit, interest, other income, property income, chargeable gain, total profit, less qualifying charities, and then we have to any interest towards particular that can be expense, property income, which we need to be again property rule, accounting period normally 12 months, if less than we need to be proportion. So please, we included some in the handouts which you can look around, and the links is available there which we can look around some examples in the following example. So next week, we'll go through our LO3. Please, make sure you join those are listening this recording. Anyone, any question, if you have, please drop me email anjum@ukversity.co.uk. We have the different, the VAT scheme. We have the standard scheme, which is mean every quarter you do a quarterly return, or you do the annual accounting, which mean one return in a year, or you follow cash accounting at the flat rate, whichever scheme you need to be look around the threshold, and then you need to be follow the rules accordingly. And if you don't submit the returns, you'll initial £100 penalties for self-assessment, and then more than 90 days in the fines, so we have to go accordingly. Anyone, any question? Okay, not. Okay, we'll keep up to here and hope all speak to you during our next lesson, and have a lovely weekend. Speak to them. Thank you. Bye bye.